Hey guys, so today I want to take you guys to Robinhood and I want to go over the option chain. Now, if you've seen my other video that I did a while back where I showed you guys how to navigate and open a trade on Webull and pretty much explain the option chain there. Now, there are a lot of people who find Webull to be a little bit complicated, and that's understandable. I do agree that Robinhood and SoFi are much more user-friendly, but really quickly, on Webull, you are able to change from the more advanced mode to a light mode. So you should be able to do that in your settings. So if you are using Webull or you've been exploring it, you can switch between advanced mode and light mode, and it'll clean things up for you a bit. Okay, but this particular video is how to read the option chain and pretty much letting you know what everything means when you are opening trades on Robinhood. And before we get into it, I'll have a little pop-up somewhere for you to be able to click on that video where I did the full visual walkthrough on Webull's end, and on this one we're going to do Robinhood. Now, I decided to come over here on Apple. Okay, when you go to Apple, you will be able to select that you want to buy, sell, or you want to trade options. Now, for this one, we say we want to trade options, and the very first thing you're going to see is what you believe the stock will do. Okay, do you believe that it's going up? You will be looking to get into calls. If you believe it's going down, you'll be looking to get into puts. If you believe that it can go up or down, you will be looking at straddles and strangles. I talked about what these two strategies are on my YouTube as well. I'll have a video pop up, a link pop up for you to be able to watch that later as well. Okay, now if you believe that the price will just stay the same, move a little bit sideways, not too far up or down, you will be able to look into calendar spreads. I will have a video on that one coming soon, okay? But we're going to keep this thing simple. We're going to say we believe that the price is going up, all right? We're going to look at a single leg, and we're going to look at a long call. Now, covered calls, I talked about that one most recently. You can find that video on my YouTube as well to understand what that strategy is, okay? So we're going to hit long call. And the first thing I want to look at is at the very top. You guys notice where it says September 19th. That is the expiration date. So these here, where I am clicking, are expiration dates for how long you want to be able to hold this trade. That doesn't mean you have to hold it that long, but that is just letting you know how long you can hold it before it expires. All right. Now, we're going to go back to September 19th. And before we get into the actual option chain or the details of a particular option, I want you guys to take note of something. September 19th is in 3 days, okay? You notice where it says for a $240 strike price, it will cost us $1.57. You will multiply that times 100. I talked about that recently. Why that number will change, okay? It doesn't mean it's going to cost you $1. It will be $1.57 times 100. It will cost you $157 to enter that trade. Now, this is why I wanted to point that out. We're going to go to a September 26th expiration, which is in 10 days. And you notice that that same $240 strike is now $3, which will cost you $300 to enter. That is because the further out you go on your expiration, the higher the premium will get, because technically you're just buying time to be able to hold your trade and let it make its move. Now we're going to click one, and this is what I wanted to talk about in the video. Okay, so we're just going to stay on this one, and we're going to pick a $240 strike price. Now, that strike price is just the target price. Okay, it's a target price that you have for this option. Now, as you can see here, it says the current share price for Apple is $237.91. That is what this number is in this middle. Now, everything that is up here is what you will call out of the money. This is just basically saying that these are options that are not fully in value just yet. Okay, but you will notice that when you open trades, even with out of the money option, you will still be able to see it gain some value. Maybe not as fast as the ones that you see here, which is at the bottom. These are in the money, and the further you go down, they are deep in the money. Okay, I will have a pop-up somewhere where you can learn about what that means as well. But I don't want to cram too much in one video, okay? So we're going to go, and we are going to hit the 240, and we are going to go over everything that you're seeing here. It may look complicated, but I promise you it's not as complicated as you think. The first thing, You see bid and you see X, okay? Bid and X are buyers and sellers. The bid is the amount that buyers are willing to pay at this moment. Now, the X is the most that they're willing to sell it for, okay? So when the bids come in, that's just basically saying the buyers are willing to buy at $2.96 right now. And now with the X, you have sellers who's willing to sell for $3. Okay. Now you notice that it has $2.96, and then you have the X, which is $3. It has what you call a spread of about 4 cents. Okay. And the spread is just the difference between the bid and the X price. Okay. Little note here. If you see a spread that is like massive, sometimes the bid may be $3 and the X may be, let's just say $3.50. That's a 50-cent spread there. And a lot of times, the higher the spread, it could potentially mean that there's not a lot of liquidity there and it's not a lot of interest there right now. And so you kind of want to steer clear sometimes, depending on the condition, from anything that has these massive, massive spreads. Now, right under that, you will see mark, last trade, and implied volatility. Now, the mark is just like a fair value that this particular option is currently worth, okay? Nothing too heavy to pay attention to, because a lot of times the mark will be very close with the bid price. Okay, a lot of times it may be the same, but that's just a fair value of that option in that moment. Okay, now the last trade is just basically saying this is what this particular option was last trading at. In this case, it's $2.97. That just means that at some point the bid was at $2.97, and currently it's showing $2.96. That is all that is. It's just giving you a general idea of what it was last trading at. Okay, now as you can see, the market is closed. It is now 6:30 at the time that I'm doing this video. Market has been closed for what, about 2 hours now. So that just letting you know what it was last trading at. Okay, implied volatility is just letting you know how much volatility is expected on this stock. How much is it, expected to swing, as far as price swinging. Like how massive can it rally or how drastic can it drop? The best place to see extremely high volatility is Tesla. And you know what? That would be your homework for this video or after this video. Check out Tesla's option chain and look at their IV or implied volatility, and you will notice that it is extremely high. And I will say this before we get into the next part. You will notice that the IV is extremely high when earnings are about to take place. Let's say the company announced that a product launch is about to take place, something massive, something drastic is about to take place. The implied volatility will be extremely high because massive mood swings are potentially going to happen. Okay, so that's just what that is. It just gives you an idea of what type of mood swing this stock will have. Okay, that's all that is. So keep it in mind though, because you want to be sure that you're on the right side of the trade, especially when that IV is high, so that you're not getting caught on the wrong side and losing money. Now, this part where it says previous close just lets you know that that was what this particular option was at one point. It was at $2.49, and by the fact that it's up to about $2.96, it showed $2.96 from $2.49, showed you that this thing has moved up in value. Okay, that previous close from $2.49 to $2.96, it showed that if someone got in at $2.49, that they're currently in profit because the value of this option has increased from their previous close. Now the high tells you how high this $240 strike has been, meaning that it was $4.65. So if someone was holding this, let's just say one contract, they at one point had $465 in value on this particular option. That right there is just letting you know how high that this particular option has been. Now, the low, $2.26, just telling you the low that it's been. The same way you can see the high that a stock has been, to just say for the day, you can see the low. The same thing with option. You can see its previous close. You can see how high it has been at one point. You can see how low it has been. In this case, it has been $2.26. Now, me personally, I would look at something like that and kind of say, okay, I see what the high has been, so I have an idea of where it can go. I see how low it's been, so I see how far down it can pull back. I think I want to wait for a little bit of a pullback to get this $240 strike price before I enter my trade to maximize my profits, because I already have an idea of where this particular option can go, or this particular $240 strike could go. Now let's look at this next row. We have chance of profit, volume, and open interest. Now the chance of profit is just letting you know, hey, this is the probability that you could see some profit in this particular strike. Okay, it's accurate here, but it could do whatever. Okay, just because it say 30% chance of profit does not mean that your chance of profit is extremely low, because it could still increase in value regardless. Apple is a mover. It does move, maybe not massive increment, but getting in at the right place, timing your entry, and letting it hit its mark, you will definitely see some profit. Okay, but that right there just gives you an idea of what is the probability that this particular option will profit. Don't let that percentage scare you, because sometimes you may see 2% chance and you have a decent amount of profit, because you never know exactly what that stock will do. And especially if you're basing it off technicals or whatever may be happening with that company, probabilities change. The volume is just letting you know who at the party, who's out here trading this particular call option, how much volume has been pumped into this call option. Okay, 27,333 people or trades has been placed with this particular option. That volume is just letting you know that there are people there actually pushing into this call option for $240 on Apple. Okay, that's all that is. And that's the same thing with the open interest. It's just letting you know who's even interested in this particular call option. Now remember, if we go back, there are plenty of strike prices here to pick from. If we go to a 215, the open interest is 721, volume is 56, chance of profit 48%, okay, approximately 48%. These things change across strike prices, okay? This is just letting you know who is interested in what particular strike prices at that moment. These things will reset every single day. So what I'm showing you guys now in this video could look completely different tomorrow morning when the market opens, okay? Because the option chain has to reset. All right, so you may see something that's pretty low, but it will reset. People will get back to work, and you will see the volume pumping, open interest, either increasing or decreasing. All right, so let's go and let's scroll up. All right, now we have our Greeks. Now, if you have seen any other videos I've done, I talked about the two most important Greeks, okay? That is our delta and that is our theta. But you may see that there are three others here. We have the delta, the gamma, the theta, the veta, and the rho. All right, the delta is letting you know how much in value your option will move. Personally, I do not trade with anything less than a 2-digit delta, but most importantly, I make sure that all of my trades have at minimum a 50-cent delta, or at least I try to, okay? But I do not go outside of a 2 digit. I said if I see something that says 15 cents, I got to have some massive confidence in it, because I want my trade to move in value as quickly as possible, especially when it's time that I have no desire to be in my trade too long. All right, so that delta just lets you know how much in value that your option will move, okay? And in this case, it will move at 44 cents per dollar that the stock move. Now, keep in mind that each contract represents 100 shares. So when it comes to calculating that, don't just think because it moved $1, you're going to get 44 cents. It don't work that way. I won't cram it all into this video, but I will do a how to calculate the value or the profits on an option trade by using your Greeks. All right, so let's focus at the task at hand. All right, now the gamma is just plain and simple, letting you know how much the delta will increase as the stock moves up $1. So if the delta is letting you know how much you'll make per dollar, the gamma lets you know how much the actual delta will increase per dollar that it moves. Your delta will not always be the same, especially the closer that it gets to the expiration date. You will notice that your delta is decreasing heavily, okay? So the delta could be 44 cents right now at the time that we're doing this video. It could be 50 cents tomorrow. It could drop to 30 cents tomorrow. Your gamma just lets you know how much in value that this thing will change per dollar. If the stock were to drop $1, and your gamma says that it's 0.4 cent, that means that if this stock were to drop $1, the delta will drop to 40 cents from that 44 cents. Okay, I hope that makes sense. So the gamma is just letting you know how much in value that delta will change with the stock. All right, the theta. Oh, this is the super important one alongside that delta because it is a time decay measurement tool. Okay, this lets you know how much in value that your option will lose the longer you hold it, especially if it's going against you. Now, I want you to do something like go to Tesla or maybe SPY and look at their option chain. They have extremely high IV because the price in these stocks could change heavily throughout today. And so that theta will be extremely high, especially when it is a high volume and when there is massive, massive trade volume taking place with that stock. And one like Tesla that moves in 10, 15, 20, sometimes $30 increments, you will notice extremely high thetas. And that is why you will always want to be on the right side of the trade when it comes to those type of stocks, okay? So you definitely want to pay attention to your theta. I like to see a lower theta than my delta. I do not like to see a matching delta and a theta. But hey, it happens, and sometimes when you get risky on the market, it's just gonna happen. Okay, so you definitely want to pay attention to your theta because it lets you know how much of your option will lose value over time. The Vega is ties directly into your implied volatility. Now I talked about that in another video where I was pretty much explaining implied volatility, but the Vega is just letting you know what by 1% rather that your implied volatility will move every time the stock moves, whether up or down. That Vega is just measuring how much in value that implied volatility will move. Okay, it's not really a huge one to pay attention to, especially when the implied volatility is low. It's not really a heavy indicator that we're watching for. It's mainly the delta and the theta. Okay, and that rho, it just has to do with interest rate. Lets you know how much this option will change based on the interest rate change at 1%. Nothing too heavy, and it's not one that we pay attention to unless there's just some drastic change to interest rates. And that's that, you guys. So everything on this particular option chain or this particular option that you just need to understand, a lot of this is very self-explanatory when it comes to it's telling you exactly what it is. The mark, the last trade, your previous open, high, lows, chance of profit, open interest and volume. All of this stuff is self-explanatory. I know sometimes the implied volatility in the Greeks could be a little bit confusing, but overall, once you fully get it and you are paying attention to the right thing, then you will know exactly how to better pick your strikes or how to better pick your expiration dates, okay? Because these things will change the further that you go out. Now, this is something that I want to kind of point out before I close out this video. If the volume is extremely low on a stock, you will probably notice a massive spread. And a lot of times you want to maybe find something a little bit different depending on what your game plan is for that trade. Because when the volume is low and the liquidity is low on that particular option, you will notice these massive, massive spreads, and you will see that your value or the profits that you think you may have is a bit wonky because the spread may be, let's just say, a 50-cent spread, $1.50 spread. You will notice this on very, very low volume stock. That could be something like Ford or maybe American Airlines or just these really cheap stocks that no one is really paying attention to or really trading. You may try to do it because it's super cheap, but you notice that spread is crazy. The bid and ask like has this massive, massive gap in between, and you will notice just how wonky your profits. You may think you're up 150%, but when you go and try to sell it, you will notice that it is not allowing you to actually sell it at the ask. You're just selling it at the bid, which will be much, much lower. So definitely keep in mind that the volume and the interest in that to be sure that you're getting into a decent option trade, okay? Or just take into consideration your plan. Pay attention to that spread, that bid, and that ask, along with everything else that you may be seeing there, okay? So I hope this video helped. If you're a user of Robinhood, that was just something to show you guys, explain what's on that option chain. And if you want to get a full in-depth one with Webull, you can actually find that on my page, okay? Full visuals showing you entering a trade, explaining that option chain as well. A lot of people are using Robinhood, so I definitely want to kind of explain that because I have a lot of questions about what do certain things mean on the option chain and when you click on that strike price. So take all of this information to your next trade, or when you're testing the waters, you now know and have a little bit more of an idea of what every single little piece of information that you're seeing there, so that you know how to go about it. And with that, I will see you guys in the next one.